everyone, and welcome back to Bonnie's Life. If you felt like you were on a financial roller coaster this week, you weren't alone. The crypto market has been a whirlwind of activity, a real tug-of-war between bullish optimism and bearish fear, with massive price swings that have left even seasoned traders a bit dizzy. We've seen everything from major regulatory news and macroeconomic shocks to huge institutional moves and, of course, the ever-present influence of political rhetoric. So, grab your coffee, settle in, and let's untangle this wild week together. We're going to break down what happened, why it happened, and most importantly, what it could mean for your portfolio this weekend. If you're new here, make sure you hit that subscribe button and turn on notifications because this is the kind of analysis you don't want to miss. Let's start with a bird's eye view of the past 7 days. The global cryptocurrency market cap is currently sitting at around $2.36 trillion, according to CoinGecko data. That's a 2.3% dip over the last 24 hours alone, which really captures the nervous energy we're seeing right now. Bitcoin, our market leader, is trading at approximately $66,115. It's seen a 3% drop in the last day and roughly a 1% decline over the week. Ethereum is at about $1,950, taking a harder hit with a nearly 6% drop in 24 hours. BNB is holding relatively steady at around $636, while XRP is trading near $2.33, and Solana is at approximately $140. This price action reflects a market that's grappling with some serious cross-currents. On one hand, we saw a midweek surge fueled by speculative optimism and some positive institutional signals. On the other, the week ended on a much more fearful note, driven by macroeconomic concerns and a massive options expiry event that we'll dive into later. The Fear and Greed Index, tracked by CoinGlass, has plummeted to a score of 14, which is deep into extreme fear territory. To put that in perspective, a score below 25 is considered extreme fear, and we haven't seen levels this low since the depths of the 2022 bear market. This is a classic sign of widespread anxiety among investors, but as any contrarian will tell you, it can also be a signal that the market is oversold. The big question is, are we looking at a prime buying opportunity, or is there more pain to come? Now, let's break this week down day by day to really understand the narrative. Monday kicked things off with a shockwave from outside the crypto space. The United States government announced a sweeping 15% tariff on a wide range of imported goods. This came after the Supreme Court struck down most of the previous tariff framework, and the White House wasted no time implementing a fresh round of levies. This wasn't just a minor policy tweak, it was a major geopolitical event that sent ripples across all financial markets. The immediate reaction was a classic risk-off move. Investors got spooked, and they started dumping assets they perceived as risky, which, as we know, often includes cryptocurrencies. Gold, the ultimate safe haven, surged to a new all-time high of $5,226 per ounce, while oil held steady near $65.53 per barrel. The market immediately felt the chill as concerns over a potential trade war and its impact on global economic growth took center stage. FedEx even filed a lawsuit against the US government seeking a full tariff refund, joined by major companies like Costco, Revlon, and EssilorLuxottica. This set a very cautious and uncertain tone for the rest of the week. Tuesday was a day of reckoning. The fear that started on Monday intensified dramatically, and we saw Bitcoin hit its weekly low, tumbling down to around $62,500. This was a significant drop of nearly 10% from recent highs, and it was driven by a few key factors. We saw clear evidence of whale activity, with large holders taking profits off the table. According to on-chain data from CryptoQuant, several wallets holding over 1,000 Bitcoin moved significant amounts to exchanges, a classic precursor to selling. This, combined with a broader deleveraging across the market, created a cascade of selling pressure. Adding fuel to the fire, the spot Bitcoin ETFs, which had been a major source of buying pressure earlier in the year, saw significant outflows. This marked the continuation of a 5-week streak of net outflows that had been draining institutional confidence since January 23rd. The combination of these factors created a perfect storm that pushed the market down to its lowest point of the week. Fed officials Bakin and Musalem also made hawkish comments about inflation, with the producer price index rising 0.3% in January, exceeding market expectations and further dampening risk appetite. Wednesday marked a pivotal turning point for the entire market. The market was on edge, waiting for the earnings report from Nvidia, the tech giant at the heart of the AI revolution. Why does a chipmaker's earnings matter so much to crypto? Because in today's interconnected markets, major tech earnings are a barometer for overall investor risk appetite. Nvidia's performance is seen as a proxy for the health of the entire technology sector, and when tech is healthy, investors are more willing to take risks in adjacent markets like crypto. A strong report from Nvidia could signal that the tech sector is thriving, which often translates to more confidence in other growth assets. And that's exactly what happened. Nvidia delivered a blockbuster earnings report that exceeded Wall Street expectations, and the market breathed a collective sigh of relief. We saw a significant recovery in Bitcoin's price, with the largest cryptocurrency posting its best single-day gain in 10 months, surging approximately 6% in a single session. Just as importantly, the spot Bitcoin ETFs saw a dramatic resumption of inflows, with over $764 million flowing in over just 2 days. This was a clear sign that institutional buyers were stepping back in, seeing the dip as a buying opportunity rather than a reason to panic. This was the first real sign of bullish strength we had seen all week, and it set the stage for Thursday's fireworks. Thursday was the day the bulls really came out to play. Building on the momentum from Wednesday's Nvidia-fueled rally, we saw Bitcoin rebound strongly, climbing back up to over $67,244. Ethereum also had a great day, hitting its weekly high of $2,150, with its funding rate returning positive at 0.23% on Binance, a sign that leveraged traders were once again betting on upside. But the big story on Thursday was the surge in altcoins. We saw some of the largest daily gains of the entire year across the altcoin market, with Solana gaining 8.8%, XRP rising 6.9%, and BNB climbing 6%. What was behind this sudden burst of optimism? A few things converged. First, the positive sentiment from the Nvidia earnings was still rippling through the market. Second, we had President Trump's State of the Union address, which contained some notably crypto-friendly rhetoric that further boosted confidence. Third, from a technical perspective, we saw a massive $220 million in short liquidations. This means that traders who had bet against the market were forced to buy back their positions at a loss, adding even more fuel to the rally. It was a classic short squeeze, and it reminded everyone why betting against crypto can be a very expensive proposition. Michael Saylor's strategy also announced the purchase of another 592 Bitcoin on Monday, bringing their total holdings to a staggering 717,722 BTC, purchased at an average price of $76,020. That's a company putting its money where its mouth is, even when the market is down. And that brings us to Friday, a day of extreme tension and volatility. The main event was the massive options expiry. We had a staggering $8.9 billion worth of Bitcoin and Ethereum options contracts expiring simultaneously. This is a huge event that always brings a lot of uncertainty and price volatility as traders position themselves around key price levels. The max pain price for Bitcoin was set at $75,000, meaning that market makers had the most to gain if Bitcoin settled near that level. Obviously, we were trading well below that, which created significant pressure on the market. Adding to the tension, we had the release of the latest PCE inflation data, the Federal Reserve's preferred measure of inflation. A hot inflation number could have signaled that the Fed would keep interest rates higher for longer, which is generally bad for risk assets like crypto. As it turned out, the data was largely in line with expectations, but the combination of the options expiry and the inflation data created a very choppy and nervous market. Meanwhile, US-Iran nuclear talks in Geneva showed what Oman's Foreign Minister Badr al-Busaidi called significant progress, with negotiations set to resume at a technical level as in Vienna next week. By the end of the day, Bitcoin had pulled back from its highs, and the fear and greed index had plunged to that extreme fear level of 14, a clear sign that the market was ending the week on a very uncertain note. Beyond the daily price action, several major calendar events shaped the market narrative this week, and their impact will likely spill over into the weekend. The most significant, without a doubt, was the colossal options expiry on Friday. We're talking about a nominal value of nearly $8.9 billion in Bitcoin and Ethereum contracts maturing. For Bitcoin alone, the max pain price, the point at which the largest number of options contracts expire worthless, was pegged at a lofty $75,000. This created a powerful gravitational pull, with market makers and large players potentially manipulating the price to their advantage. While we didn't hit that level, the immense pressure and volatility surrounding this event were a primary driver of Friday's chaotic price action. CryptoQuant's weekly report, released on Thursday, noted that the Bitcoin CME futures yield curve slope has been trending lower since early 2025, mirroring the pattern observed before the 2018 to 2019 and 2021 to 2022 bear market cycles. However, the analyst emphasized that the curve remains firmly positive and upward sloping, indicating that we haven't reached capitulation levels yet. In their words, longer-dated contracts still trade at a premium to spot and short-dated futures, which means positioning stress has not reached the levels historically associated with market bottoms. Another bombshell came from Tether, the issuer of the world's largest stablecoin, USDT. On Friday, Reuters reported that Tether had frozen a staggering $4.2 billion worth of its tokens due to links with illicit activities. This is a massive move and a powerful statement that deserves careful analysis. On one hand, it demonstrates Tether's increasing cooperation with law enforcement and its efforts to clean up its image in the eyes of regulators. On the other hand, it's a stark reminder of the centralized control that exists even within the decentralized world of crypto, and it raises important questions about censorship resistance and the power of stablecoin issuers. If Tether can freeze $4.2 billion at will, what does that mean for the promise of permissionless money? This is a developing story that could have long-term implications for the entire stablecoin landscape, and it's something that every crypto investor should be paying close attention to. Looking ahead to the immediate weekend, we have a couple of significant token unlocks on the calendar that could create localized selling pressure. On Saturday, February 28th, Jupiter, the leading decentralized exchange aggregator on Solana, is set to unlock nearly 7.94% of its circulating supply, worth around $39.34 million. That's a substantial amount of new supply hitting the market. Then on Sunday, March 1st, SUI will unlock over 1.13% of its circulating supply. While these aren't massive in the grand scheme of the overall crypto market, token unlocks often lead to increased selling pressure as early investors, venture capital firms, and team members are able to sell their holdings for the first time. History has shown that large unlock events can suppress prices for days or even weeks, so it's definitely something to keep an eye on, especially for those holding JUP or SUI positions. On a more forward-looking note, Ethereum co-founder Vitalik Buterin unveiled a 4-year roadmap for the network, which he called the Straw Map. This plan includes some highly ambitious and, in his own words, invasive changes that could fundamentally reshape Ethereum's architecture. The most notable proposals include a shift to post-quantum cryptography to defend against future quantum computing security threats and a dramatic reduction in transaction finality time from the current 16 minutes down to just a few seconds. These are not incremental improvements. They represent a fundamental reimagining of how Ethereum works at its core. While these are long-term developments that won't affect prices tomorrow, they are crucial for Ethereum's future scalability and security, and they provide a fundamental bullish narrative for the ecosystem, even amidst short-term market turmoil. For long-term Ethereum believers, this roadmap is exactly the kind of forward-thinking leadership that justifies continued conviction in the project. So, with all that in mind, what are the key triggers to watch for this weekend? Let's break it down with some technical and fundamental analysis. From a technical standpoint, Bitcoin is in a precarious position. It's currently hovering around the $66,000 mark, but the real battle is being fought at two critical levels. The first is the 200-week exponential moving average, or EMA, which is sitting at around $68,068 according to FX Street's analysis. This is a major line of resistance that has historically acted as a key pivot point in Bitcoin's price history. A decisive break above this level would be a very bullish signal, and it could open the door to a retest of the upper consolidation boundary around $71,746. On the flip side, we have immediate support at the 78.6% Fibonacci retracement level, which is around $65,520. This level is drawn from the August 2024 low of $49,000 to the October 2025 all-time high of $126,199. If we close below that on a weekly basis, the next major support level to watch is the key psychological barrier of $60,000. A drop to that level could trigger a massive $1.22 billion in long liquidations according to CoinGlass data, which would create a cascading wave of downward pressure. The Relative Strength Index, or RSI, is giving us mixed but interesting signals. On the weekly chart, it's reading 27, deep in oversold territory, which historically suggests a bounce is due, but on the daily chart, it's at 42, rebounding from oversold territory but still below the neutral 50 level, indicating that the bearish momentum hasn't fully dissipated yet. The daily MACD has shown a bullish crossover that remains intact, which is a positive sign, but the weekly MACD bearish crossover from mid-August is still in play. 7 consecutive bull divergence signals have fired on the RSI, which is a rare occurrence that often precedes significant price reversals. On the fundamental side, the picture is just as complex and requires careful navigation. The reaction to Friday's PCE inflation data will continue to ripple through the markets over the weekend. Any signs that inflation is stickier than expected could lead to a stronger dollar and more headwinds for crypto. We also need to keep a close eye on the political front. Any new tariff rhetoric from President Trump or developments in the US-Iran nuclear talks, which are set to resume at a technical level in Vienna next week, could inject fresh volatility into the market. The continued flow of money into the spot Bitcoin ETFs will also be a critical indicator to monitor. Through Thursday, we saw $814.86 million in net inflows for the week, which, if it holds through Friday, would break a 5-week streak of outflows. If we see strong inflows continue, it will be a powerful sign that institutional conviction remains high despite the fear in the market. And of course, we have those token unlocks for JUP and SUI, which could create some localized selling pressure on their respective tokens. But perhaps the most powerful fundamental indicator right now is the extreme fear in the market itself. While it feels uncomfortable, it's often in these moments of maximum pessimism that the best buying opportunities arise. The fact that we're seeing a decline in the amount of Bitcoin held on exchanges, with another 6,500 BTC flowing out to cold storage, suggests that long-term holders are accumulating, not selling. This is a classic bullish divergence that suggests the smart money is quietly betting on a recovery, while retail investors panic. Historically, Bitcoin has averaged gains of 12.21% in March, which adds another layer of optimism for those willing to look beyond the current fear. So, what's the final verdict for this weekend? The market is on a knife's edge. We have a classic battle between fearful retail sentiment and bullish institutional accumulation. The technicals are pointing to a major confrontation at the $65,500 support and $68,000 resistance levels. And the fundamentals are a mixed bag of inflationary concerns, geopolitical risks, and long-term bullish developments. Bitcoin is on track to close February with a roughly 14.5% loss, marking its 5th consecutive month of correction since October 2025, a streak not seen since 2018. But remember, after every period of extended decline, there has been a recovery. My advice? Be cautious, but don't be scared. This is not the time for panic selling. It's a time for careful observation and strategic positioning. Keep a close eye on those key technical levels. Watch for any major news developments over the weekend and be ready to act when the opportunity presents itself. And as always, do your own research and never invest more than you're willing to lose. Thanks for tuning in to Bonnie's Life. If you found this analysis helpful, smash that like button, subscribe to the channel and hit that notification bell so you don't miss our next update. Drop your thoughts in the comments below. I want to know, are you buying this dip or waiting for lower prices? Stay safe, stay informed, and I'll see you in the next one.